After revealing their long-awaited AI strategy, Apple is once again the world's most valuable company. Welcome back to the AI Daily Brief Headlines Edition, all the AI Daily news you need in around 5 minutes. We've been tracking the Apple AI strategy announcement all week. On Monday, I gave you my first takes just after the presentation. On Tuesday, we talked about the conversation around privacy and whether Apple could thread the needle between wanting to give you AI-powered experiences that relied on all your personal context while also keeping all of your personal data safe. We've also been tracking how much the market was responding to things. And initially, there were some big questions. In fact, Apple's performance on the day of WWDC on Monday was its worst WWDC keynote day performance in at least 11 years. However, then yesterday, it seems like the market digested the news, and Apple rocketed up to new all-time highs, becoming once again the most valuable company in the world, overtaking Microsoft for that position. On Tuesday, Apple was up about 4%, reaching $215 a share for a market cap of $3.29 trillion. That followed a 7% bump the day before. Said Michael James from Wedbush, all those questions about Apple lagging from an AI technology standpoint were answered at the Worldwide Developers Conference. Some of the specifics about AI capabilities that are going to be integrated into the upcoming iPhones made it very apparent that there will clearly be demand for a significant upgrade cycle. One of the things that analysts have been looking for is a reason for people to want to upgrade their iPhones. At this stage, a huge portion of Apple's revenue still comes from the iPhone specifically, and each year there's a question of whether the new features justify an expensive upgrade. Analysts are betting that these new AI capabilities, which will only be available for the latest editions of the phone, could be enough to get people to switch up. Compared to other companies in and around the AI race, Apple's 2024 performance overall has been a bit lagging. They're up 12% now on the year, but they were basically flat until this presentation. Compare that to Microsoft, which is up 16%, Alphabet, which is up 28%, and Nvidia, which is up 154%. So what was it between Monday and Tuesday that got people to get back on the train with Apple? Sergey Alexishenko argued that it was Ben Thompson's strategy article about WWDC. He said, I am personally convinced that it was Ben Thompson's opinion that moved Apple over 5% up. His newsletter came out within 15 minutes of the bottom tick. It was a glowing endorsement. Before that, the market wasn't sure how to parse the news. Would be the most impactful newsletter issue ever, a $150 billion market cap move in Apple. On the flip side, Neil Seibart said, I would use extreme caution interpreting what's going on with Wall Street as it pertains to Apple. Attributing any single day move to a particular news catalyst is a futile exercise. Yesterday, Apple shares closed up 7.2%. That is one of the strongest moves higher in recent years. For a $3 trillion market cap company, it's noteworthy. One would assume the move higher was related to WWDC. Every Wall Street bank published their WWDC reaction article the night prior. However, there are a few things that give me pause about that thinking. Apple shares did not gap significantly higher between Monday's close and Tuesday's open. In fact, there was no gap at all. This suggests there was not a sudden event or realization the prior night or morning that led to a dramatic shift in demand and supply of issues. Shares opened somewhat calmly at 193 on Tuesday. So what happened? Basically, Neil points to more structural possibilities. For example, he said, yesterday demand and supply of Apple was not necessarily driven by participants buying or selling because of WWDC or Apple Intelligence. Instead, computers took over as Apple began to flash positive trading signals. To have shares of the largest company, mind you, move a few percentage points higher in an hour triggers bells on trading desks. Have it move 5% higher, more bells. 7%, even more bells. The fact that these moves weren't overnight gaps factored into the programs. To then have all-time price highs be involved and technical resistance levels be broken? Yep, more bells. He also pointed out that the buy side has been underweight Apple all year, and that, quote, given Apple's weight in the S&P 500, if it's underweight in a fund's portfolio and then moves significantly higher in price, that potentially equals a bad day for those funds. As a result, they would need to buy Apple shares to increase their exposure. All really valuable caveats and some super interesting analysis. Speaking of super interesting analysis, investor Sam Lessin argues that the OpenAI Apple deal is really, really bad for OpenAI. He writes, OpenAI isn't going to win this, no chance. Apple, with the users, distribution, and critically built-in app content and developer ecosystem, will. Apple just put ChatGPT in a tiny, tiny box and turned it into best-case commodifying content middleware. This is no Google-style relationship. He said the deal is just terrible for OpenAI and really spells the end for ChatGPT. They just got appled. How? Well, it is one thing to be Google and have a super strong economy so you can pay Apple for search and distribution. But OpenAI can't possibly afford that because they don't have a business model that works. So what happens? Apple puts them in a teeny tiny box as an optional upsell sometimes, which they can change at will and offer alongside anything else they want. You know what that does? That makes ChatGPT nothing more than a dumb content provider. This is a much broader question, something that we'll probably explore here. But for now, I will just leave that hanging out in the air for you to digest. Speaking of OpenAI, the company has hired a new CFO, Sarah Fryer, and a new Chief Product Officer, Kevin Weil. Sarah Fryer, who was recently the CEO of Nextdoor, is joining as the company's first Chief Financial Officer, and Kevin Weil previously headed up product at Twitter and Instagram. By and large, these are seen as ringers, and OpenAI really gearing up to compete in an even more intense environment. Speaking of an even more intense competition environment, France-based Mistral has finally secured that round that we've been hearing about for months, pulling in $600 million at a $6 billion valuation. This is right around 1 year since the company was launched, and is triple the valuation of the last funding round back in December. The round was led by General Catalyst and also included existing investors including Lightspeed, Andreessen Horowitz, Nvidia, Salesforce, Samsung, and IBM. And if you want to get clear on who they're going after, Arthur Mensch, the CEO, told the Financial Times, "We were told when we started that this is a market that is never going to be disrupted. We showed that this wasn't the case, and we effectively disrupted the OpenAI business model." One of the things that makes people so interested in Mistral is how they seem to be doing more with less. From the FT, Mensch said that Mistral has used a little more than 1,000 of the high-powered GPU chips needed to train AI systems and spent, quote, just a couple of dozen millions of euros to build products that can rival those built using much bigger budgets by some of the richest companies in the world. Said Mensch, "We seem to be doing very different calculations of the cost needed to build large AI models." Still, they say this fundraising is about being competitive in a capital-intensive market. Mensch said the more computing capacity we have, the more we can get into our team to break the barriers of artificial intelligence. So lots of interesting things going on, but that is going to do it for today's AI Daily Brief. Next up, the main AI breakdown.